think that I want to dictate the entire class session. I would love for us to do um, more questions from you, more interaction, etc. Right? Because again, I don't want to bore you. Okay, that's the hardest thing. I've always told my teams when I was an academic dean that the last thing I want is to bore you as students. So please, if there's ever a question, you know, let's talk about it. I know some of you make sure that you're chatting in the chat box as well if you don't feel comfortable speaking, etc. Um, but you know, I would appreciate let's do that conversation. Now, I do want to thank all of you who wished me well at last week. I do apologize for missing class. There's been a lot of weather change here. I don't know if you guys experience it where you are, and those changes in the weather patterns have really they messed with my sinuses and things. So anyway, enough of that. um so yeah, let's hop in since we are looking at four different chapters today. Don't let it stress you that we're going through four chapters. Again, they're all going to be things that you're going to see. There's terminology as we start to go through things that's going to seem very common over time, and that is the purpose, obviously, of what we're doing in this class. um, Before we get started, does anybody have any questions as far as anything for the class so far? Feel free to put something in the chat if you need to.
I have a question.
Yes.
I'm not sure which assignment, but I didn't. I emailed it to you. I
Okay.
did not upload to the model.
Oh, okay.
So,
Okay.
is it okay? Because I emailed it on the um at the before the due date.
Right,
So,
right.
yeah,
Yeah,
is it
and
okay?
it
Or should
is
I
at this
upload it
point.
on Moodle too?
Yeah, everybody's been doing a great job, and I appreciate that question. I wanted to let you guys know that you guys are doing an excellent job when it comes to the paper so far, the discussion posts. You're definitely understanding the material, which is the most important point. When it comes to the quizzes and things like that, I don't make those difficult for a reason. The goal for me is just to make sure to see that you understand the concept, and everybody's been doing great on those. But thank you for that question. Yes, you're doing very good in the class, and I do appreciate that. um, and I'm honored with you guys the way you've been doing, so kudos to you.
Okay, okay.
Yeah,
Thank you. So it's okay whether we email it or upload it to
yeah,
Moodle.
you can upload it or email it. I'll accept it
Okay,
either
okay.
way. Because with the way with Moodle is sometimes, as you guys know, it's finicky. We've seen it go up and down a couple times. So I'm happy to accept it by email. And even my students at the other university, we use a product called Canvas. I don't know if you're aware of it, but even it'll have its moments. So um, great part about technology is we have many ways. So even if you couldn't email it to me and you wanted to send it to me via WhatsApp, I'll accept it as well. Okay. You guys
Okay,
just
thank you.
send that to me personally via my WhatsApp number. Very good. All right. So, Ahmed, since you said you kind of went through the reading and stuff, I'm gonna let you teach today.
That's bad. That's very bad for me.
No, that no, I won't do that to you. I won't put you on the spot, but I appreciate that. But no, if anybody did get a chance to go through the mortgage markets, go through those videos, and you definitely want to share throughout the day, that's great. So okay, so we're going to talk about markets first. So um, I don't know how many of you are familiar with mortgages, right? That's the process of owning the home, but you're going through a institution to purchase that home. Some people are fortunate; they don't have to. They can buy a house, but many of us we have to, of course, purchase our homes using lended money. So that's exactly what a mortgage is. It's a loan to individuals or businesses that allow you to purchase home, land, or other property. Um, and I would again, I'll ask this question. I would assume that that's the same in in all countries, but that's definitely the same in the US. Do any of you own a home now that you actually own, or are in the process of owning, purchasing? You can put it in the chat box if you want. Now, for me right now, I've owned 5 different homes, believe it or not, or was in the process of purchasing. Now I am renting, just based on different scenarios. And again, I've shared that with you in the past. I'm open about sharing that because I don't want people to make the same mistakes that I have. Which actually, this is a very good topic for us to go through today because I'll reiterate a couple of those areas that I went through. Um, Anybody? Sarah, Rhoda, Ahmed, do you guys currently, are you purchasing your home? Do you guys rent in your location?
Well, for me, since I'm a foreigner here, I'm not allowed to buy any home, so it's just rental.
Okay, so in your country, you're not allowed to purchase.
No, no, no. In my
No, I'm
country, I'm
speaking about
allowed
in
to
your
purchase.
country. In your country, yes.
No, I am allowed. I am
Oh,
allowed,
okay.
but it's a little bit expensive.
Is it okay? Well, and we're running into that too, Ahmed, in the U.S., especially now. All of a sudden, remember I shared with you guys the a couple weeks ago that now that the interest rates have started to go up, the mortgage market has kind of slowed down. There were houses that were on the market for, you know, less than a day being purchased, and now they're sitting a little longer just because of the interest rates. So yeah. Okay, so many mortgages, they're securitized. And what does that mean? Securitization occurs when those securities, they're packaged and sold as assets backing a publicly traded or privately held um, debt instrument. And I'm going to show you in just a second a video to give you kind of a better understanding of that. So we'll watch a video. Mortgages differ from bonds and stocks that we've talked about. Okay, the reason they differ is mortgages are backed by a specific piece of real property, i.e., the house, the land. Primary mortgages have no set size or denomination, so the dollar amount is not set. It's going to be based on many different factors. The primary mortgage generally involves a single investor, i.e., what? A financial institution. Okay. And comparatively, little information exists on mortgage borrowers, i.e., you or me, if we were borrowing money on the home. Okay. So, but let's go back real quick. I want to show you a quick video on securitization so you can get a better idea of the topic. Now, as you know, you guys can see my screen, correct? You can just put that in the chat box if you can see my screen. Okay. Is everybody able to see? I just want to make sure. Yep. Okay. Thank you, Dania. And so what I'm going to do, let me know if you cannot hear this once I hit play. All right. So let's look at securities real quick.
Do you love Gantt charts? Here's how easily you can build one in Click.
Securitization has revolutionized the banking industry. And that's because banks historically were almost entirely reliant on deposits to raise funds. But now they can securitize mortgages, they can securitize car loans, credit card receivables, and this provides an alternative source of funding other than deposits for banks to raise capital. So, what is securitization? Securitization is the process of bundling illiquid financial assets and creating securities that are then backed by the cash flows from that pool of assets. So you can bundle mortgages, you can bundle credit card receivables, equipment loans, and so forth. Okay? When you bundle mortgages, it's called a mortgage-backed security because the cash flows for that security come from this pool of mortgages. So you could have thousands of mortgages in that mortgage-backed security. Okay? And then investors, they invest in that mortgage-backed security, and the cash flows that they're ultimately receiving come from those mortgages. Now, the bank that originated the mortgages, they will typically come in and service the mortgages. So they get a fee for servicing the mortgages, because the investors who come in and buy the mortgage-backed securities, they're not going out and knocking on the borrower's door and saying, hey, you know, your mortgage is due, I need that money. Okay, so the bank basically unloads these mortgages, puts them in a pool, unloads them to investors, and then the bank continues to service the mortgages, and then the investors get the cash flows from those mortgages. Okay, now asset-backed securities. And so a mortgage-backed security is a type of asset-backed security. Okay. Other types of asset-backed securities, credit card receivables, car loans, student loans, equipment loans. So any kind of loan could be basically packaged, put into a pool, and then you've got an asset-backed security. Okay. So those are the different types of securitization. Now, how do you value these mortgage-backed securities, these asset-backed securities? Well, that's a tricky part. Okay, cash flows are uncertain for a number of reasons. So you've got interest rate risk, prepayment risk, which is heavily tied to interest rates. For example, if interest rates come down, if the refinancing rate goes down, then people are going to refinance their mortgages, so they're going to prepay and so forth. So that's a risk. And then you've got the risk of default, right? You've got credit risk. These people might not pay, and we saw that in the financial crisis, where a lot of these mortgage-backed securities were subprime loans, right? Subprime mortgages, and the people ended up, there was a really high rate of default, and basically a lot of these mortgage-backed securities were virtually worthless. Now, how do banks try and value asset-backed securities? They use Monte Carlo simulation to try and simulate, okay, what would be, you know, what kind of interest rate environment do we expect? What kind of prepayment rate will we expect if this happens, if that happens? Okay, so that's how they try and value mortgage-backed securities and asset-backed securities. So it is by no means an exact science. Okay, they're using simulation to try and value these assets. Now, what are the advantages of securitization for the bank? Why is securitization so popular? Why do banks engage in this? Well, first off, you're taking illiquid assets, which there's risk associated with, and we just talked about there could be default, for example, and you're getting them off the bank's balance sheet. Okay, it's reducing regulatory capital requirements for banks. Banks have a lot of requirements. They're heavily regulated in terms of what kind of capital they need on hand. Okay, so it's easing some of the restrictions there. And as I said, most importantly, is raising cash for the bank. This is an alternative source of funding. The bank is basically saying, look, I can go and originate mortgages. So I go and make loans, okay, and then I don't have to worry about whether, you know, there's going to be default or things like that. I can sell these mortgages or credit card receivables, whatever. Okay, I can get them off the balance sheet and raise cash. And now that I have that cash and I have increased liquidity, what can I do? I can go and make more loans. Okay, so that's the advantage of securitization for a bank. You don't have to sit around and wait for depositors to come and give you money. You can just unload the mortgages or credit card receivables, car loans right now, take the cash, and then now you can go out and make even more loans. Now, why would investors like mortgage-backed securities or asset-backed securities? Well, we're talking about mortgage-backed securities in particular, for example. They are basically getting to invest in mortgages in the housing market, but they don't have to go and originate or service the mortgage.
When it comes to mortgages,
Sorry about
there's
that,
no
guys.
one-size-fits-all option. Here are a few different types of mortgages you may encounter. A conventional mortgage is a loan that's not backed by a government agency, such as the Federal Housing Administration or Veterans Affairs. There are a number of conventional mortgage options available, such as a 30-year fixed rate, a 15-year fixed rate, and adjustable rate mortgages. Then there are loans with lower down payments that help make homeownership possible for many more people, such as Chase Dreammaker, FHA, and VA. You'll need to meet certain income requirements for a Dreammaker mortgage. Monthly insurance payments will be added to an FHA loan. VA loans are exclusive.
I don't know why that did that to us. My apologies.
Okay, this is going to sound a little nuts, but the fastest and easiest way to make passive online income on
Securitization has revolutionized the banking industry and asset-backed securities. So it is by no means an exact science. Okay, they're using options there, and as I said, most importantly, is raising cash for the bank. This is an alternative source of funding. The bank is basically saying, look, I can go and originate mortgages. So I go and make loans, Okay, and then I don't have to worry about whether there's going to be default or things like that. I can sell these more.
Okay, so my apologies
When it
there.
comes-
I didn't realize they didn't get into for the investor. Okay, so let's talk about that a little bit. As far as, again, what do you think, again, why is it that the when it comes to the securitization, why is it the banks want to be able to do it? Anybody? Based on your
Again, please,
understanding?
Professor.
What's that?
Can you repeat that question again, please?
Yes. So again, why do you think that, again, just to kind of repeat what was in the video and what we just talked about, why do the banks, the financial institutions, why are they interested in the securities? Why do they want to do that to help them? What does security mean? You want to create safety, right? So how are they creating it? Dania says, as a backup of the loan, just in case the people didn't pay. Exactly. That is exactly what it is, right? Because there is that default risk that you, me, the other person that borrowed on that loan could default, that maybe we can't pay it. And this way, they are able to create some safety for themselves by selling these packages to an investor, right? Now, the video cut off a little bit, but what do you think, again, why do you think the investors like buying these packages? Why do you think they want to do these, again, why do they want to purchase these packages? What are they getting out of it, right? Remember, they talked about that in the beginning of the video, but what doesn't the investor get from buying these mortgage packages, these securities from the banks? What are they getting? Okay. What they're getting is obviously money, right? Because they're going to charge a rate to the bank for saying, hey, here's some money for you. I'm going to charge you a rate. But the other thing to me, which is the most important, is they don't have to collect on those loans because the bank's still doing the servicing, right? Okay. Let me give you an example. In one of my businesses I have, what I do is I sell products on a site, but I am not keeping that product in stock. I have another company that sells that product. So I'm investing in their product, right? They're doing all the legwork because they're housing the product. They are making the product and sending it out to my customers. Okay. And so I've limited the amount of work that I have to do, but I make an income because I'm investing in that. And that's the same, kind of the same scenario here. That investor is collecting money. They've said, here you go, bank. We're going to give you this money so you can allow others. You're freeing up some of your money this way. You're allowed to give others mortgages. And it's again, what have we talked about? It's a cash flow, it's a cycle. Okay. But they're getting interest. They're not handling the day to day.
Professor,
Yes.
I'm kind of lost here.
Okay.
Okay. So for me, I'm a customer. I want to buy a house.
Yes.
Okay. So I go to the bank.
Mm-hmm.
Okay. Either I take loan from the bank or I ask the bank to buy this house for me and I pay it, right?
Mm-hmm.
So the investor here is the house owner. Am I right or wrong?
No, you are the
Okay.
purchaser, but you are not the investor. Because remember, an investor is somebody that's putting money into it up front. You're buying the bulk, right? Whereas when you're buying the house, you're the customer. Like when you go to the grocery store and you buy a package of noodles, right?
So
Yeah, you're
one minute.
paying.
Okay.
Yep.
Okay. Let me try to rephrase it. Okay.
Okay.
So person X, he has extra money, he put it in the bank. Okay.
Yes.
I want to buy a house. I go to
Hmm.
the bank. Okay. The bank gives me the money from the person X account. Okay. I have to pay a certain fees or a certain interest to the bank plus the principal. Okay. So the bank is dividing it's this income. Something goes to the bank for their service, and something goes to person X because he is the owner of the money. Am I right? So he gets his money plus interest. That the bank gets their interest because they facilitate the process. Okay,
Hmm.
and I get the house and pay for it. Interest plus principal.
Yeah. So that's your initial, right? So that's the initial step of it, right? You're the borrower.
Mhm.
You have to excuse me. You're the borrower right here.
Yes,
You've got the money from the bank,
yes.
right? Okay, you're paying them. So ultimately, once you pay off that loan, that asset that they talked about in the video, that's the house,
Mhm.
right? That's the
Belongs
asset.
to me eventually.
It belongs to you once you pay all of that money off, right?
Mhm.
Now,
Yes.
the other layer here is this. So let's take you out of the picture now. Okay.
Okay.
Now let's talk about the bank. So we've got the
The bank.
bank. Okay. The bank, in order to allow them to be able to give out more loans, let's say to Rhodas, me, Dania, if they used only that money that you're paying to them, they're going to run out of money to be able to give to others, right? Because they only
Mhm.
have so much money. What they
Yes.
do is there's an investor. Let's say I was a multi-billionaire and I want to invest into the financial institution. I will say to the bank, okay, bank, I'm buying up these 10 houses. Let's say they put it in a package, right? I'm buying up this money essentially from you that you have. I'm giving you that additional money. What I get in return is money on my own. So essentially, we've taken what was you and the bank, and now we've got the bank and the investor. So it's adding a layer, right?
So this is the secondary market, right?
Correct.
Okay. Now it's clear.
Okay. Now, the reason that the banks do that security and they sell to that investor is one, it frees up money for them to give additional mortgages, but it also gives them a level of security now because they got money for that house, right? They got money for that loan that was ultimately given to you. So they're kind of taking some of that risk off of themselves in case you default on that loan. Okay. So that's what we're looking at here. Does that make a little more
So
sense?
if I default, okay, then
Mhm.
the investor will take the house
Ultimately, the bank takes the
or the
house and
bank.
then resells it. Yes, it goes to the bank, right? Because again, the investor's saying, hey, I'm giving money, but the asset isn't mine ultimately. Okay. The asset still belongs to the bank, but it does suck for that investor though, because if you don't pay on that, the bank has to take it back. That means the investor loses money. However, what's the bank going to do if they take that property from you? They're going to resell it, right? They're going to want to get at least what was owed on that house so they can ultimately do what? Make sure that the investor is getting their money back plus interest, right?
Yes.
Yeah. Okay. So great. I love what I love that you asked that, Ahmed. So I'm glad. I hope I made that clear. So anybody else have anything? Dania, do you have any questions, comments? So let's go on to primary mortgages. Okay. There's 4 basic types of mortgages that are issued by institutions. You have a home mortgage, again, which is you or me, where you can purchase up to what we consider 1 to 4 family dwellings, okay, which is a single family mortgage. Multifamily dwelling mortgages are used to purchase apartment complexes, townhouses, and condominiums. Okay, so that's more of a business transaction. You have a commercial mortgage, which is used to finance the purchase of real estate for business purposes. And you have farm mortgages, which are used to finance the purchase of farms. Now, obviously, there are going to be regulation for each of these type of mortgages. Now, let's look at the amount of money that we're looking at that is outstanding. Now, this was as of 2018. So the financial institutions that have lended money towards the purchase of homes, there is $10.8 trillion in outstanding loans out there since 2008, as reported by the institutions to the banking and regulatory. On the multi-family dwellings, again, apartment complexes, townhouses, and condos, there's $1.47 trillion. Commercial, $2.8 trillion, and farm mortgages is 0.25. Why do you think farm mortgages are so low in the outstanding loan market? Anybody want to take just a guess?
They are not able to pay back. Recession, the economic situation.
That could be part of it, but it's so small because if you think about it, where does most of your populations live? Where do most of your people live? They live in what? Small towns, cities, right? Areas where there's not going to be farmland as much. And that's one of the other reasons that the number of mortgages is not higher when it comes to that. Okay, so that's where I was going with that. So this is just a visual. If you were looking at it, that shows you kind of the amount of money that's outstanding. Now, what's interesting is there were more in 1995. 76% of 1 to 4 family homes were, again, the home mortgage. 2018, there was 70.5%, which is interesting because what we see here is while the number of single family homes was less of the overall market, look at the dollar difference. $3.46 trillion in outstanding loans in 95, 10.87 trillion in 2018. Again, what caused this, do you guys think? Anybody want to take a quick guess on that one? Don't be shy. Okay.
Everyone want to buy a house, but eventually they couldn't afford it.
Well, again,
They have.
yes. So the market, you're correct in one sense, Ahmed, because so we have less people buying a home 2018 compared to 1995, but yet look at again the dollar amount in outstanding because of, like you just said, in your country, the price of a home is so expensive that most people couldn't buy. So that's kind of where we see that. So you have more people, where I would believe that means that we have more people living, renting than we do buying, purchasing, right? Let's look at another one real quick. What was interesting is the number of multifamily residential units actually went up from 6% to 9%. And look at the dollar. Well, let's exclude the dollar amount. So I'm not worried about that. Why do you think more people are living in multi-family residential units versus back in 95? Why do you think somebody would purchase a multi-family unit?
Cheaper, and families are getting bigger, you know, like
Yes.
I prefer to
Families.
have my children around me,
Mm-hmm. Right.
so I would buy
Well,
for them. So I would buy a complex if I have the
yes.
money, of course.
That's okay. That's a good point. That's a good point. But here's the other reason. At least in the US, this has become a very popular trend. People buying what we would call the duplex, right? So you got essentially two houses connected, and they would rent one side and live in the other. So what is that doing? They're getting rent and helping to pay their mortgage. So more people started to do this. And again, like you said, same thing, right? They can purchase and maybe have two families living in those units, and they're still offsetting and helping themselves. Now, again, the price of the real estate went up, but that's a good point that Ahmed that you made. Okay, let's talk about mortgage characteristics. So all mortgages, they are backed by specific pieces of property that serve as collateral. Okay. Again, the house is the collateral. Bank's going to give you the loan because they know that if you can't pay, they're going to get the house. Now, many of them require what we call a down payment, which is the portion of the purchase price, okay, to borrow the money up front. So they're saying, all right, I'm going to give you money, but I still want to, for my safety, have you put a certain amount down. Okay. So you have a down payment. Just like if you buy a car, there are dealers that'll say, okay, I want to be able to get the bank to lend you money for this car, but the bank's going to say, I still want a down payment on that. All right. Then we have what's called PMI, or private mortgage insurance. This is generally required when the loan to value ratio is more than 80%. Okay. Which means that, for example, if the bank requires a down payment of less than 20%, right? And the bank is making more than the 80% ratio, they want to make sure that they are covered. There's some backing on their end. That again, they're trying to reduce their rate, right? Because not only, Ahmed, are they trying to make money again from you, who are they trying to also protect by putting things like this insurance in place? And not just themselves. Who else are they trying to protect when it comes to that money? Anyone?
The investors.
Absolutely. There you go. Right? Simple. Because they got to pay that investor back, and that investor is going to say, hey, I'm not going to invest any more money in you. Okay. Now, what are federally insured mortgages? These are mortgages where repayment is guaranteed by the FHA, which is a government entity, or Veterans Administration. Again, another government entity. Okay. Now, the only mortgages that are not federally insured are what we would consider conventional mortgages, which are what many individuals qualify for. So really, again, there's nobody other than the bank and the borrower involved here in a conventional mortgage. Okay. Now I'm going to go skip over that. We kind of looked at the excuse me, went to the wrong thing. Okay, let's talk about the characteristics again. Continue. We've got now a mortgage is amortized when the fixed principal and interest rates fully pay off the mortgage by its maturity date. Now, we'll look at that here in a second, and I believe we already have a little bit, but when you're paying on that loan and Ahmed, you kind of alluded to this a little earlier, you're paying more of that interest on the front end. Again, what's that doing? That's helping the money or the bank protect themselves from or giving you that money. Okay. And so they're going to collect that on the front end in case you ever default. And then as we get further along, okay, we are going to see that you'll pay what we consider then just the principal. Okay. So let me show you this real quick. It's just a 1-minute video. Okay. And I'll show you this and we'll go from there. So give me 1 second. And this is kind of talking about amortization, which we'll cover a little bit more in depth in a minute. Okay.
Principal is the monies that's being applied to pay off the loan. Interest is the portion of the payment that's being given to the mortgage company, essentially because of the fact that they're lending you the money. That's the portion you're paying back to them for that ability. The principal and interest payments, the interesting thing is that, it's not an even split amount. So every single month when you say make a $500 payment, it's not that $100 goes into the interest and $400 towards the principal every single month. So you kind of think of it like a sloping mountain in a sense, where, in the beginning of the term, you pay the most interest. And as time goes by, you pay less and less interest, so that mountain starts sloping down. And what happens then, because your payment is staying the same, that while the interest portion decreases, the principal payment or the monies that's going to actually pay down the loan will increase month over month.
Make sense? Okay. Now we've got what we consider what are called balloon payment mortgages. Now, balloon payment mortgages, they require a fixed monthly interest payment. All you're paying is the interest. You're not paying principal. But after that 3 to 5 year period that they've approved you for that interest only payment, okay, the mortgage principal is due. I don't know if you guys remember that, like I shared with you guys, back in 2004, 2005, 2006, I borrowed money on a house that should not have been given to me, okay, because I really couldn't afford it. But what did they do? They broke my loan into 2 different ones. I had a conventional loan, but then there was additional money the conventional loan wouldn't cover. So they gave me a balloon payment loan. Okay. Now, a balloon payment loan, as I mentioned, you're only paying the interest. So let's take that conventional loan out of the picture. I'm paying for 5 years, interest only to the bank. So they're making their money. But at the end of that 5 years, guess what I need to do? I've got to figure out how am I going to pay that actual paper value, that full value of that principal off. And what do many people have to do? They end up having to borrow. Okay. Now, in my case, because I moved, I sold that house. Here's that balloon payment I was making that I wasn't able to get enough money to cover that off. So I ended up having to write that loan off. But where I'm going with that is the bank made their money because I was paying them some of that interest. So I defaulted, not fully. I did what we call a short sale. But because I defaulted on some of that, they still made their money on that particular piece of the loan. Okay. But that was the problem back then when the bust happened, is too many people were in my situation. They were given these loans, these 2 different types of loans, your conventional plus this balloon loan, with the belief that their income is going to continue to raise and that at the end of the several years, they would be able to reborrow or what we call refinance and be able to blend those all together. And that doesn't happen. And that's what caused that bust in some respects to occur. Okay. Now, what's a fixed rate mortgage? A fixed rate mortgage is one where the interest rate that you agree to with the bank locked in. Pretty self-explanatory. Okay. So they're not going to ever increase per the contract you signed with them, your interest rate. So if you got the house at 3.5%, that's what you're paying. Okay. Each month. An adjustable rate mortgage will have a higher interest rate that's timed to some type of market rate. So if you're approved for an adjustable rate mortgage, you have to worry about what's the market doing. So for example, in the last several months, we've had the interest rate hikes that have occurred because of inflation, right? So if somebody has an ARM loan, you or me, if we had an ARM loan, we now could see our payments going up, okay? Because we signed a contract for an adjustable rate mortgage. Now, why do you think a bank would want to give somebody an adjustable rate mortgage loan versus a fixed rate mortgage loan? Anybody's thoughts on that?
Again, the question, please.
Yes, great. Thank you for asking. So why would a bank, Ahmed, like let's say to me, want to approve me for an adjustable rate mortgage versus giving me a fixed rate mortgage? Thoughts?
I was answering, but my mic was off.
That's okay.
More beneficial for them. The higher the rates, more interest for them.
Correct. Why do you think though they would want to, or why wouldn't they just want to give? Yes, and here's the other piece of that, and that was the harder part for me to ask the question on. If I, for example, defaulted on a loan in the past, but they were willing to give me a loan, wouldn't they want to again protect their interest, right? So, like you said, yeah, they're earning more interest, but it's also to protect their interest in giving the loan too, because someone like myself that had that issue could be a higher risk of default. So they want to make their money, right? So that's the other reason that they give arms. Okay. Everybody pretty understanding of the pieces we've covered so far? Thumbs up in the room or in the chat box. You good? Okay. All right. Let's look at mortgage characteristics. Again, we've got we've got what we call discount points. So these are fees or payments made when a mortgage loan is issued at closing. Okay. So when we go to sign the paperwork, that's closing day, right? And so they're going to issue discount points, which is the discount point that's paid upfront is equal to 1% of the principal value of the mortgage. Okay. So they're adding on a 1% fee onto that principal value of the mortgage. So again, if there is money, it's a risk factor that they're doing there. So again, if I was what 1% of $1,000 would be what $100, right? So what they're saying there is I'm going to go ahead and give you this again mortgage, but I got a fee that I'm adding on, which is 1%. So that way, again, it's another way for me to make sure I get my money in case you default on that loan. Mortgage contracts generally require that the borrower pay an assortment of fees to cover the mortgage issuer's cost of processing the mortgage. Again, you've got your application fees, title search, title insurance, appraisal fees, all kinds of fees. Well, that's the mortgage contract that happens. All right. Again, that's just it's more of what we would consider an administration fee. It's a fee to make sure that the property that they're giving you money for, okay. My ex-wife just ran into this. Her and her significant other are purchasing a home right now. They wanted to go to the bank to get the loan. The bank said, no, the owner of the home that you're buying it from wants X number of dollars. We did an appraisal. We feel that the home is only worth X number of dollars. So that's the amount we would give you. Well, they're going to charge you a fee because they had to send somebody out to do that appraisal. So that's essentially what we're talking about there. We're talking about admin fees and other fees that get associated with it. Okay. Mortgage refinancing. That's when, let's say me, I've had a loan with the bank for 15 years on a 30-year mortgage. Okay. And I need to, I want to pay off that loan because the interest rates are much better. So what can I do? I can go borrow money to pay off that loan, but guess what I'm going to do? Now I'm going to give them more money. Or let's say my house needs a new roof. Okay. I've had the house for 15 years. I've been paying on it regularly. It needs a new roof, and let's say I want to put in a new kitchen on it. Well, that might cost me $25,000 to put the new roof and new kitchen on. Well, I don't have that kind of cash laying around, so I may say to the bank, okay, I've started to earn equity in my house. Can I please borrow that $25,000 plus, let's say, what I owe, what's left on that original loan I borrowed, and write a new loan? Okay. So the bank's already made their money because they gave you that mortgage. They're going to say, well, sure, you've been a good customer to me. So what I am going to do for you is I'm going to go ahead, let you borrow the amount that pays off the rest of that mortgage, okay, that you had left, that first mortgage, and also borrow that money to, because there's enough equity in that home to put the new roof on and redo your kitchen. Why do you think that the bank would want to do that? Why would they want to refinance that and do the mortgage refinancing for that person? What do they get from doing that? Anyone? Okay, I'll give you a couple things. They're keeping their customer, because that customer could always go to another bank, right? And say, hey, here's my mortgage, what's left of it. I need this. So one, they're keeping their customer. Two, by giving them a new mortgage, they're back to gaining new interest. Because again, the scenario I gave you, that person had paid the interest, right? They were halfway through on a 30-year loan. They were at year 15. They are done paying interest. They're paying all principal now. So they're just paying on the initial amount that the bank gave them. So now the bank is going to start making some interest again on an amortized schedule. And again, now we go to the amortization, which I just showed you that video of, right? That's the amount of money that you're paying on the front end to own the home. Now, I'm not going to go through today the calculations because of our time. Let's talk about other types of mortgages. We've got what's called a jumbo mortgage. Jumbo mortgages are those that exceed the conventional mortgage conforming limits. Okay. So what does that mean? Limits are set by two government sponsored enterprises, Fannie Mae and Freddie Mac, and are based on the maximum value of any individual mortgage they will purchase from the mortgage lender. Oops. We have a subprime mortgage, which are mortgages to borrowers who have weakened credit history, right? These borrowers may have weakened credit due to payment delinquencies and possibly more severe problems such as charge-offs, adjustments, or judgments, and bankruptcy. So these are two additional types of mortgages. More. As you can see, there are a lot of different types of mortgages. We've got what's called an Alt-A mortgage. These are considered riskier than a prime mortgage, but less than risky than a subprime mortgage. So interest rates on these types of loans are usually between prime and subprime rates. And then option ARMs are adjustable rate mortgages that we just talked about a minute ago that offer borrowers several monthly payment options. Okay. Again, we talked about the interest only option. We talked about minimum payment option, or we didn't, but we have minimum payment option, 30-year fully amortized payment. Okay. Where basically what they're saying is, hey, we're going to give you this loan, but we're paying the principal and interest on the loan over 30 years versus that amortized schedule, and 15-year fully amortized payment, which is based on 15-year term. Okay. Again, because of your potentially credit history, etc. We have second mortgages, the loan secured by a piece of real estate already used to secure a first mortgage. Okay. A home equity loan, which is letting you borrow on a line of credit with a second mortgage on the home. Okay. And we have what's called a reverse annuity mortgage. Now, that one is something that's been very much become advertised in the US over the last couple of years. So in the reverse annuity mortgage, the borrower actually receives a payment from the bank, right? When the RAM matures or the borrower dies, the borrower's estate sells the property to retire the debt. And RAMs are attractive mainly to the older homeowners who have accumulated substantial equity in their home. So remember a minute ago, I shared the refinancing scenario. So Ahmed, you're a bank.
It looks like the other way around. Like
It is.
the
It
bank
is.
is paying me because eventually the land or either my heirs will sell the property and pay them, or the bank will take the property.
That's exactly what
Right?
happens in the, yes, that is exactly what happens in it. So you're basically, again, I had that house that I bought 30 years ago. I now own it. The bank now says, hey, I want to buy your house. I'm going to pay you. When you die, though, your family, you can't will that to them because you own it. You can't will that to them because you're signing a contract saying that I'm paying you, so now that now becomes my property. That's essentially what they're doing. Exactly. So you were right on point there. Okay. Now, let me clarify something for you guys. We were talking about that home equity. I did the refinancing piece, right? With talking about borrowing against the additional home. that could fall into that home equity loan side of things when we talk about the refinancing side. So you're basically saying, hey, my house has value, so I want to borrow basically like a line of credit against the house. Okay, so I have a second loan um, on the house, right? So in a refinance stage, you've borrowed that money against the home, but you've also paid off that first loan. In a home equity loan, what you've done is you've said, okay, here's my initial mortgage. I'm still paying on it, but I'm borrowing like a line of credit against it. I'm saying, I want to put that roof on. Maybe I don't want that kitchen, but I need like $10,000 to put that roof on the house. So what they're going to do is they're going to say, okay, we'll create another loan for you, but your collateral is what? The house is still the collateral if you were to default, right? So that's essentially what they're doing with the home equity loan. Make sense?
Yes.
Okay. Now, secondary mortgage markets. Secondary mortgage markets are where the institutions remove the mortgages from their balance sheets, right? Through one of two mechanisms: by pooling their recently organized or originated mortgages, and by securitizing mortgages, right? Again, we started the today's lesson with that. So we've already kind of talked about that. What is the advantages? Well, again, we talked about this. They're going to get rid of that liquidity risk, the interest rate risk, and the credit risk, but they're also generating fee income, which will help them offset the effects of what happens from regulatory constraints. So let's talk a little bit about the history of and background of the secondary mortgage market. So the mortgage market is unique in that the US government is deliberately involved in the development of its secondary market. So in 1938, the government established what we call the Federal National Mortgage Association, or now Fannie Mae, to buy mortgages from banks so they could lend to other mortgage borrowers. Okay. To encourage it, the continued expansion, to promote competition, the government created the Government National Mortgage Association, Ginnie Mae, and Federal Home Mortgage Corporation, or Freddie Mac. Okay, so that's just a quick history of it, where it came about. Let's talk about mortgage sales. Financial institutions have sold mortgages and commercial real estate among themselves for 100 years. Okay. The largest part of that is the correspondent banking, which involves small banks. Remember, we talked about the different regions, the banking institutions. So now we're talking about the small bank, okay, making a loan that's too big for them, for their balance sheets, right? Because it's going to make them look like that they now have spent more money than they've made at the end of the year. And they're selling parts of that loan to the large bank, okay, for whom they had the long-term deposit and lending correspondent relationships, okay? So essentially, I'm the small bank and I'm going to sell. This is kind of the investor, right? The large bank becomes the investor in this situation that we talked about earlier, okay? And how does that flow? You got small bank to the large bank to federal government, which is the investor. So as you can see, there's a correlation between all of that. Now, mortgage sales occur when the financial institute originates the mortgage and sells it to the outside buyer. Okay. Now, that mortgage could be sold with or without what we call recourse. Okay. We talked about the mortgage securities again, mortgage-backed securities. Again, it involves pooling the mortgages with similar characteristics, the removal of these mortgages from the balance sheet, because again, what I did was I'm a small bank. I had that money that I lent that I spent essentially on my balance sheet. I'm now in a negative. I sold it to this larger bank so I could clean up my balance sheet. So now it doesn't look like it's on my balance sheet. Okay. And so they're also selling the subsequent sale of their interests in the mortgage to the secondary investors. Again, that investor is going to want that interest that they're going to get from it. So mortgage-backed securities allow mortgage issuers to separate that credit risk. Again, that's what we already talked about. There are three major types of mortgage-backed securities. There's what we call a pass-through, a collateralized, and a mortgage-backed bond. Okay, so let's look at a pass-through security. Now, pass-through securities, I'm going to go down here a little bit because I think I might have, no, I did not put that in there. Okay. Pass-through mortgage securities promise payments of principal and interest on the mortgages, right? Remember the bundle of mortgages that were created by the banks to the secondary market participants that are holding interest in the pools. Okay. All right. So they're saying, I'm the bank now. I've sold to the investor. All right. This bundle of loans, this bundle. And now I'm saying to you as the investor, hey, I'm going to make that payment to you that I borrowed, let's say $10,000, but I'm also going to be making that interest payment. Again, if I'm an investor, I don't want to just give somebody my money to use and they're going to give it back to me. I want to make something off of it, which is why I gave it to them in the first place. And that's what we're doing here. Okay. Does that make sense? Everybody with me on that? Let's make sure you're with me on that. Anybody? Olia, Rodas, you guys with me?
Again,
Go
please.
ahead, Ahmed.
Again, please.
You want me to go through that again?
Yes, please.
No worries. Okay. So again, all of pass-through mortgages, okay, the security is, remember, we talked earlier about the bank, so they can free up money on their balance sheet, okay? They're going to sell loans, a bulk package of loans. They're going to sell a 5 bananas versus 1 banana. They're selling 5 bananas to this person that's invested in them, right? So I don't really want the bananas, but I'm going to give you the money for it, so you have more to be able to spend on others, give others loans, okay? But I want my principal, again, the money that I gave to you. So I gave you, as an investor, as a bank, I gave you $5 because that's what you were selling to me. That was that loan bundle. But I also want, on that $5, I want you to pay me 30 cents because I want to make my $5 back. And I want to get that 30 cents. So I make $5.30. That's what we're talking here. Okay. That's essentially what we're talking about with a pass-through mortgage security. Does that help a little bit, Ahmed?
Yes.
Okay, cool. Okay. So now we have 3 agencies that are involved in these mortgage-backed pass-through securities. Again, we've already kind of talked about them. We've got Ginnie Mae, Fannie Mae, and Freddie Mac. Okay. So with private mortgage issuers such as banks and thrifts, also purchase mortgage pools, they do not conform to government-related issue standards. Okay. So there are going to be certain industry, or excuse me, persons that are not conformed to these. Okay. So the pass-through, again, I already talked about them. I'm not going to go through the different, these association corporations when they were founded. I'm not so much worried about that. Now, one thing that is interesting, though, is if you look at Freddie Mac, they represent a huge presence in our financial system. They have over 44% of these single-family mortgages and the mortgage pools. Again, that's them being that investor to the banks, right? They're investing into those. So they're saying ultimately, hey, I've invested money into these banks so they can give more loans. They have 44% of that market as investors. Okay. Now, in the early 2000s, they came under fire because of the authority to take over. Okay. Their ability to take over as entities, which is kind of that separation of law and state, right? That's Big Brother kind of taking too much. And if you look, the amount of money that they've given, that's essentially what we're talking about there. Let's continue with the types of mortgage-backed securities. Now, we have the collateralized mortgage obligations, okay? These are mortgage-backed bonds, so they're bonds, right? They're paper with multiple bondholder classes or tranches. So each bondholder class has a different guaranteed coupon. The mortgage repayments retire only one tranche at a time, so other tranches are sequentially prepayment protected. Now, again, Ahmed, when we talk about bonds, remind me, who could be a bondholder?
Anyone.
Right.
Investor.
So what we're
anyone.
saying, yeah, exactly. So what we're saying here is rather than that one investor like Freddie Mac, you or I could have a bond stake into this collateralized, right? So we've purchased paper from investor XYZ. Now they have our interest involved and we want those bonds to pay for us. So now they've bought that. So essentially that's exactly what we're talking about here. Okay. And again, each bondholder class has a different guaranteed coupon. So, this investor might let me purchase bond and paper from them, but it's going to be at different rates. Okay. Depending. Really, that's going to, in many cases, that's going to depend on how much money am I putting in, right? If I'm putting 100,000 in my piece of paper and Ahmed, you're putting in 10,000, of course, my rates are going to be better, right? To collect interest on that. Okay. Now we have what's called mortgage-backed bonds. These are bonds that are collateralized by a pool of assets, also called asset-backed bonds. Now, the relationship for MBB, the mortgage-backed bonds, is one of collateralization rather than securitization. So the cash flow, okay, is not directly connected to interest and principal payments. Okay. And this right here is just the type of mortgages that are outstanding by the title holder. And we are almost done with mortgages. Now we have international trends in securitization. So what we are seeing now is international investors that are participating in the US mortgage and mortgage-backed securities markets. Okay. So that means that, again, there could be investors from India that are investing into the US mortgage market. Okay. Now we are starting to see more involvement from Chinese investors in a lot of the farmland in the US over the last couple of years. So they've been getting into this market. After the United States, Europe is the world's second largest and most developed securitization market. And Germany is one of the countries that moved towards making widespread use of securitization in its mortgage market, i.e., letting individuals from the outside come in and invest in their markets. Okay. Now, international trends that are continuing in securitization. We have synthetic securitization are far more common from a mortgage financing in countries outside the US. Okay. So what does this mean? It means that refers to structured transactions where the banks use credit derivatives to transfer the credit risk of a specific pool of assets to third parties, such as the insurance companies, other banks, and unregulated entities. These can replicate the economic risk transfers and the characteristics of a traditional securitization without removing the portfolio of assets from the originating bank's balance sheet. The reasons that some of these securitizations are there is they prefer synthetic securitization because it might include the complexity and prohibitive cost of a traditional securitization transaction, as well as potentially unfavorable tax implications. So what does that all mean? Essentially, what we're talking about here is, hey, I'll give you money. I want my interest for giving you that money, but I don't want that asset. I don't want it. You get to keep that asset on your books. I don't want it. Okay. Well, again, because if they get it, what happens? They could potentially be paying more taxes on that, right, in their countries. That's where we're going with that. Make sense?
Kind of, yes.
Kind of. Okay. What part of it, Ahmed, doesn't make sense?
No, the word synthetic securitization is like new for me, so I'm
Yeah.
googling the translation.
Well, think of it. Okay, so just to put it in a simplistic term, Ahmed, think of it as safety. Okay, to me, that's what I'm thinking of. Right? Security is safety. That's essentially the way I put it together. Okay, so I'm basically trying to safely give my money in a way that I can be able to make sure I'm going to get my money back, and I'm still securing and giving that money. I'm saying, hey, here's that money. I'm securing that for you. It's guaranteed. You're going to get it. That's what we're doing here. So I'm safely giving you that money. You don't have to worry about it. You got it. Safely giving it to you. I hope that makes sense a little bit. Okay. So we've covered everything with mortgages. Anybody other than Ahmed have any questions about mortgage markets? Anyone? Type something in the chat room so I know you're there, at least that you're there. Let me know.
You still didn't reply my question regarding the assignment to make a spreadsheet. Okay, I understood the equation and I did it multiple times through the examples of the book. Okay, but I was stuck in the assignment at the interest, what it was, discount point. I might contact you personally. Yes. Okay.
Yeah, okay. I will respond to that after class, okay? I apologize. I didn't realize that I missed that and overlooked it. That's on me.
It's okay. It's okay.
No, but I will do
Can
that
we
for you.
Can we take 10 minutes, or you can continue? I will take 10 minutes. I'll come back.
No, we can take if everybody wants a quick break, we can take a quick break. Let's take 10 minutes.
Thank you so much.
Because I don't want you to miss anything. All right, chapter 8. Everybody doing okay out there? Okay. Ahmed, by chance, are you back? Okay, I'm going to go ahead and get started here, guys, because we have about an hour left. Obviously, we're not going to get into chapters probably 9 and 10. I hope we can make sure we can get through chapter 8 here. So let's talk about the stock market. Who can tell me via the chat room, what do you know about the stock market? Anything? What's your experience with it? What do you already understand about it, if anything? Okay, let me go ahead and get, I'm going to get started. But what I am going to do for this particular topic is, so here's the overview. And then what I'm going to do is show you a quick video that I really liked from is where people, but exactly. Yep. Aaliyah, thank you. That's perfect. So what I'll do is I'm going to show you guys a quick video after we just do this little overview. So corporate stock or stock serves as a source of financing for firms in addition to debt financing or retained earnings financing. The secondary stock markets are the most closely watched and reported of all the financial security markets. Stockholders are the legal owners of a corporation, right? Again, that's you or me. If we buy stock, we are putting in ownership of that to that corporation if they're publicly held. So we have a right to share in the firm's profits through our dividends after the payment of interest to the bondholders and the taxes. So again, after payments are made to whether it be the bank or whoever that's been invested in, okay, those shareholders, after those interest payments are made, and again, the taxes are paid, then you could get what's left over, right? That's essentially what we're looking at. Stockholders also have a residual claim on the firm's assets. So again, you're getting ownership of any of the assets that they may have, okay, that they may own. There's limited liability on you because again, you're essentially buying paper is what is the way I actually kind of take a look at it. And you have actually do have voting rights, okay? You could elect the board of directors to operate. We'll see that here in just a little bit, but I don't know how many people that are involved with the stock market or if you have ownership of any stocks if you ever get involved. I know I don't, but you have that right as somebody who has purchased stock in that company. Okay. Now let's go ahead and do this. I'm going to go ahead and play this quick video. It's 4 minutes and 30 seconds on how the stock market works. Okay. So let's go ahead and we'll do that. And unfortunately, we will have to watch a quick commercial.
Are you ready for retirement? Personal Capital can help you find out. Our free retirement.
Okay.
In the 1600s, the Dutch East India Company employed hundreds of ships to trade gold, porcelain, spices, and silks around the globe. But running this massive operation wasn't cheap. In order to fund their expensive voyages, the company turned to private citizens, individuals who could invest money to support the trip in exchange for a share of the ship's profits. This practice allowed the company to afford even grander voyages, increasing profits for both themselves and their savvy investors. Selling these shares in coffee houses and shipping ports across the continent, the Dutch East India Company unknowingly invented the world's first stock market. Since then, companies have been collecting funds from willing investors to support all kinds of businesses. And today, the stock market has schools, careers, and even whole television channels dedicated to understanding it. But the modern stock market is significantly more complicated than its original incarnation. So how do companies and investors use the market today? Let's imagine a new coffee company that decides to launch on the market. First, the company will advertise itself to big investors. If they think the company is a good idea, They get the first crack at investing and then sponsor the company's initial public offering, or IPO. This launches the company onto the official public market, where any company or individual who believes the business could be profitable might buy a stock. Buying stocks makes those investors partial owners in the business. Their investment helps the company to grow, and as it becomes more successful, more buyers may see potential and start buying stocks. As demand for those stocks increases, so does their price, increasing the cost for prospective buyers and raising the value of the company's stocks people already own. For the company, this increased interest helps fund new initiatives and also boosts its overall market value by showing how many people are willing to invest in their idea. However, if for some reason a company starts to seem less profitable, the reverse can also happen. If investors think their stock value is going to decline, they'll sell their stocks with the hopes of making a profit before the company loses more value. As stocks are sold and demand for the stock goes down, the stock price falls, and with it, the company's market value. This can leave investors with big losses, unless the company starts to look profitable again. This seesaw of supply and demand is influenced by many factors. Companies are under the unavoidable influence of market forces, such as the fluctuating price of materials, changes in production technology, and the shifting costs of labor. Investors may be worried about changes in leadership, bad publicity, or larger factors like new laws and trade policies. And of course, plenty of investors are simply ready to sell valuable stocks and pursue personal interests. All these variables cause day-to-day noise in the market, which can make companies appear more or less successful. And in the stock market, appearing to lose value often leads to losing investors, and in turn, losing actual value. Human confidence in the market has the power to trigger everything from economic booms to financial crises. And this difficult to track variable is why most professionals promote reliable long-term investing over trying to make quick cash. However, experts are constantly building tools in efforts to increase their chances of success in this highly unpredictable system. But the stock market is not just for the rich and powerful. With the dawn of the internet, everyday investors can buy stocks in many of the exact same ways a large investor would. And as more people educate themselves about this complex system, they too can trade stocks, support the businesses they believe in, and pursue their financial goals. The first step is getting invested. Interested in pursuing your own financial goals? Download a free audio version of The Richest Man in Babylon on audible.com/TED-Ed. You'll not only get timeless advice on making and investing money, but also an imaginative take on life in ancient Mesopotamia. Stay one.
Okay. So, what did you take away from that video when it comes to the stock market? Type it into the chat for me. What was your takeaway? What's the importance of the stock market? Again, put it in the chat room for me if you don't want to speak. What's good for you with the stock market? What is something that you could do from it? You know?
I came at the last minute, so
Okay.
anyone can.
So it's not just you and me, Ahmed. I'll give you guys I think I gave you the links to this one, but we just watched that first video, Ahmed, about the introduction basically and how the stock market works. And essentially, you know, again, if I'm starting a company and I want to not have private investors, but I wanted it to open up to the public, obviously I could set it up to where it could have the initial public offering, right? And so if you, Ahmed, were a multimillionaire that wanted to purchase into it as initial stock, Let's see. Oh, Winnie, let me see what Winnie said, and then I'll get into it real quick here. All right, Winnie said, stock market opens up a company to the public. Yeah, that's where I was going. Perfect. To buy shares and be part of the company to get the dividends for their number of shares they purchase. Absolutely, right? Just like the investor, you've now become the investor, Winnie. Thank you so much. You've become the investor that can earn the dividends from it, which is a cool part of it, right? Now, if you saw, stock markets can also be up one time. Absolutely. Now, I think the problem with the stock market, Winnie, when it comes to that is, I think too many people, when they see it start to go down, they panic. And again, it's an ebbs and flows type of situation that everybody starts to just start selling. The downside to that is, okay, yeah, maybe you made some money as it was starting to go down. The price of the stock goes down. But if you don't, again, that's part of the financial risk. If you don't keep in there for the long term, what happens if that stock starts to go up again and you could have sold it when it was high? Many people don't, but you could. And then that way you made more money from it, right? Okay. So I know a friend of mine, what he does, he's on the crypto side, but it's the same kind of concept, is he likes to buy in when it's low, because again, you're getting more bond stocks, right? You can buy more shares at a lower price, which means ultimately you could earn more. Okay. So that's something that we're looking at. So the introduction here. Okay, so let's talk about stock market securities. Stock market securities. We've got two types of stock. We have two types of corporate stock. Excuse me. We have common stock and preferred stock. Okay. All public corporations issue common stock, but only a few issue preferred stock. So we'll take a look at that in a minute. But common stock is the fundamental ownership claim in a public or private corporation where the characteristics differentiate it to the type of the securities that you can get. Okay. You could get discretionary dividend payments. You can get residual claim status. You can have limited liability, and you can have voting rights. Okay. All right. With the type of corporations and common stock. Dividends. Let's talk about that real quick. Dividends are discretionary and they're not guaranteed, right? The payment and the size of the dividends are determined by the board of directors who are issuing or of the issuing firm, excuse me. So again, the payment and the size of those potential dividends, i.e. the interest, are determined by the board of directors. Dividends are taxed twice, once at the firm level and once at the personal level. Okay. Now, what that means, that company is going to be taxed on it, and then you can also be taxed on it. Okay. Basically, when you pay your taxes, they're saying, hey, you earned money from this, and we want to, as a government, we want our money for you earning money, right? We want you to pay your taxes on it. So you're showing that you earned so much, right? Your balance sheet, i.e. your taxes, show you had this much earning from those stocks. So we're going to pay you. So that's what we mean by double taxation. Okay. Now, some may partially avoid the double taxation effect by holding stocks in what we call growth firms who reinvest the earnings to finance larger growth rather than paying larger dividends. Again, an example, and I think I shared this last week. The one company I work with, the one university, works with another company that basically puts our money for our retirement into the stock market, right? The quote unquote 401k. That's a growth. Okay. So what they're doing is, those are growth firms. I'm not taxed on that. Okay. Because that money's continually being reinvested in something else. It's, again, growing. That's the goal. Growing it for the future of me. And I'm doing a little dance. I hope you guys like that. But that's what we're talking about here. Okay. Okay. And this is a calculation that you could use to determine how much you could get over time for the common stock. Residual claims. Common stockholders have the lowest priority claim in the event of bankruptcy. They have a what we call, again, the residual claim. So, heaven forbid, the company that we've all invested in, let's say we all have an investment into Candygram. That's the stock we have. They go belly up, they go default, they claim bankruptcy. Okay. We have what's called that residual claim. So after all their senior claims are paid, our common stockholder, me or you, is entitled to what assets that may be left. Okay. Now, the senior claims may be payments owed to creditors such as the employees, bondholders, the government, i.e., their taxes, and their preferred stockholders, which again, we haven't gone over preferred stockholders yet. Okay. So there's that risk, right? If the company goes belly up, that you or I may lose that money that we've invested. Okay. That's essentially what we're talking about here. So residual claims feature is associated with common stock, which again makes it riskier than bonds as an investable asset. Okay. Limited liability. Now, limited liability is implying that the common stockholder, the losses are limited to the amount of their original investment in the firm if the company's asset value falls to less than the value of the debt it owns. Okay. So again, if that stock loses its value, okay, I could be losing that money that I initially put in there, right? That's my original investment. All right. And it falls less than. Now I could pull my money out. Let's say I put in $5,000. They're doing bad, right? And I see that that stock's down to, or the money that I've invested is now down to 2,500. There's a limited liability there. I can go ahead and pull that money and not lose everything I've invested, but I can lose part of that. Okay. Now, here's where, in contrast, we've got what we call sole proprietorship or partnership stock interest, means the stockholders may be liable for the firm's debt out of their private wealth holdings if the company experiences financial difficulties. Okay. I could be liable for the firm's debts if their wealth holdings, again, are in trouble. Okay. So that's something as a proprietor, right? Now, I'm going to use myself. I have a limited liability corporation, an LLC. I'm a sole proprietor. I have nobody investing in me at this point. But if, Ahmed, you were to invest in my company, okay, as a limited liability corporation, and I start to lose money, that money that you've invested, essentially, I could say to you, hey, I need you to help me pay that off, any of these debts. And you'd be obligated to it as an LLC, as a limited liability. Okay. So it's a higher risk for you. Voting rights. Okay. Voting rights is just this. Common stockholders have a control in the activities that indirectly exercise their voting rights in the election of the board of directors. So again, I'm going to take Aaliyah, Rhoda, Judy Lynn, and we'll say Winnie. You guys are all vying for a position on the board of directors for a company. Okay. Me as a stockholder, I can vote on which one of you is going to get a seat. So obviously, again, it would be just like voting for you in quote unquote election. I want to be able to vote on the best people who have that company's best interest at heart and are going to bring in hopefully growth and ideas that'll help with growth and bringing in more money, right? Because ultimately, I bought the stock. What do I want? I want to earn money from that stock, right? So I get the chance to vote. I have voting rights, okay? Now, there are some firms that are organized as dual class firms where there are two classes of common stock with different voting and or dividend rights. So two methods are generally used. There's cumulative voting and straight voting. Now, cumulative voting, and I apologize if you hear a cat meowing in the background. So just a FYI. Cumulative voting is where all the directors are up for election as nominated by the shareholders. They're selected by a committee of the board and are voted on at the same time. So the number of votes in this type are assigned to each stockholder equals the number of shares held by multiplied by the number of board of directors to be elected. Straight voting is just that. The number of votes eligible for each director is the number of shares. Okay. Now, what is proxy voting? Proxy voting is a voting ballot, which is sent by a corporation to the stockholders. So again, if you have stock, you may receive this ballot that you can then return to the company to vote on who you want, right? Just again, just like next week, we have our Senate and Congress coming up for voting. So we get to go to the kitty. Sorry, baby. By 2010s, virtually all the US firms were putting proxy statements online. So you can go to, because remember, again, up until or back in the day, to vote, it's not something that many of us would do, but this actually increases our chance to vote as a stockholder nowadays because it's online. Now let's talk about preferred stock. Preferred stock is a hybrid security that has characteristics of bonds, which we already covered in the past, and stock. Okay, it is similar to common stock. It represents an ownership interest in the issuing firm, but like a bond, it pays a fixed dividend payment. Okay, so again, we're saying that you're going to get a set payment for the amount of money that you've invested, essentially. It's not going to fluctuate the payout if you were to invest. Okay. Again, the dividends are generally fixed. You're going to be paid quarterly for it. And preferred stockholders generally do not have voting rights. So you don't have a voting right here. But your stock, but most stock may be converted to common stock at any time the investor chooses. So in this case, the investor, again, that secondary company that might be working on your behalf, if you're not your own broker, could be changed over to common stock, which would then potentially change that. Preferred stock continued is essentially, we have typically preferred stock is non-participating and cumulative. And what does that mean? It means that the dividend in non-participating is fixed regardless of any increase or decrease, okay, in the firm's profit. So gaining money, losing money, okay, that it's going to be the same, your dividend. Now, participating preferred stock means that the actual dividends paid in any year may be greater than the promised dividends, okay? So if that company's doing the participating preferred stock, if that's what you've invested in, a preferred stock, and there is in excess that they earned, okay, rather than the amount that was agreed to, i.e. that bond amount, say $500, they may pay you $1,000 in your dividend payment for that particular quarter. That's essentially what that means. Now, cumulative preferred stock, okay, means that any missed dividend payments go into what they call arrears, and it must be made up before any common stock dividends can be paid. So remember, a minute ago, we talked about you could have preferred stock and common stock, right? So if I'm that common stock, remember how we talked about everybody else gets paid before you, right? All right. So if you have cumulative preferred stock, and let's say they can't make that payment to you this quarter, okay? But next quarter they can pay you, plus you're going to get your money, what was owed to you here in this quarter, so quarter 3 and quarter 4. So you'll get that money that was supposed to be owed to you back here. You're still going to get it. You're still going to get it. That's required. And you also get it before those who have common stock, right? All right. Now, dividends of non-cumulative preferred stock do not go into arrears and are never paid, which sucks, right? So you've got a preferred stock, so you're expected to get a flat rate, let's say $500 each quarter from the money you invested, but it's non-cumulative preferred stock, which means that in quarter 3, if you did not get that payment, you're not going to get it. You're not getting that payment. That's what this essentially means. Okay. So obviously there is, which type do you think a company is going to want to issue, right? Probably a non-cumulative. So if things are going up and down, I would want to, if I'm participating, know a couple different things. I would want to know, again, am I purchasing common stock, preferred stock? And then if we were looking at it, am I looking at the non-participating, participating, cumulative, and non-cumulative? Okay. So that's why we want to know these differences, because it's going to make a difference in what I could potentially gain, right? So Ahmed, I'm going to ask you the question since you normally answer for me. If you were the owner, and you wanted to set up your initial public offering, or let's go past that. You've already got your money, you're operating, etc., and you wanted to issue stocks to potential investors, to Aaliyah, let's say, right? She wants to buy some of your stock. For her, what type of stock would you want to be able to issue? Would you want to issue this cumulative or non-cumulative? Which do you think is going to attract her more if she is a preferred stockholder? Which one would be better for her? If you were to
For
say,
her will be the cumulative.
Exactly. Now for you though,
But for
as
me,
the owner,
non-participating.
What's that?
I would choose non-participating.
That's correct. Right. Right. I think
Yeah.
so. And so, but again, if she is an investor and she sees that you have non-cumulative preferred stock, there's a chance she may say, well, wait, do I want to invest in that? Because if they're doing bad, let's say they had a bad quarter, there's a chance I'm not going to get my dividends, right? But again, that's the risk. So that's, as you can see in the video we watched, it talked about that. There's such that volatility, the up and down, you need to know what are the different type of stocks that could be issued. Now, what do we have as far as our stock markets go? We have a primary stock market, which are the markets in which corporations raise funds through new issue of stock. Okay, most primary markets go through investment banks. Okay, so that's the banks that are investing. An investment bank can conduct a primary sale using either the firm commitment or best efforts underwriting basis. So there's a couple different ways that, again, they can issue a sale of it. Okay. Now, in firm commitment underwriting, the bank is guaranteeing the corporation a price for the newly issued securities. So they're saying, hey, I'm investing in you. Okay. This is, again, the primary stock market where we are raising funds in through the bank. And I'm saying to you that I will guarantee this price for these securities. Okay. In a best effort underwriting, the underwriter does not guarantee any price to the issuer. Okay. So that's essentially the biggest difference. Now, then we have what's called a syndicate. I don't know if I like that word. Usually that word is something, when I think of it, is I'm thinking of a crime syndicate, but anyway, I guess it depends on what we're thinking about. A syndicate is a group of investment banks working in concert. So they're collaborating, okay, to sell and distribute a new issue. The lead banks in the syndicate are the originating house, okay? So again, I'm the lead bank. Ahmed, you are a bank. Rodas, Winnie, you guys are all banks. We're going to work together in concert to sell and issue this new stock, okay, on behalf of that company. But me as the lead, I am the originating house, okay? So I am the main, basically, guarantor. And this is just kind of a figure that kind of shows. So you've got the issuing corporation, you got the investment bank, and you have the investors, right? So here's the corporation, the bank that's invested in them. The bank is then going to sell the stocks to me or you or to Aaliyah, okay? So I'm a corporation. We'll say I'm XYZ. I'm my consulting business, Farris Picker Consulting, okay? Ahmed, you're my bank. You've given me money, the funds. So now I've got the stocks. You're going to sell those stocks to Aaliyah as the investor. And then your goal is to collect the interest, right? And payments from that, right? That's essentially what we're doing. Again, it's all cyclical. Now, we already listened to initial public offering. That is the first public issue, okay, of a financial interest by a firm. Why would you, if you were, why would you want to be one of the first to purchase stock into this company? So the banks come to me, I've come to you, and I've said, hey, I just invested in this great company. I'm giving you a chance to invest. Why would you want to be one of the first? What do you think?
Low price compared to the price in the future, if the company is
Exactly.
doing good.
Yes, right? And by the way, I might be able to issue you what? Preferred stock versus common stock, right? So there's several advantages to being one of the initial investors into it, okay? Now, we talk about a seasoned offering. This is the sale of additional securities by a firm whose securities are currently publicly traded, and the preemptive rights, which give existing stockholders the ability to maintain their proportional ownership. Okay. So you again, Ahmed, you said, okay, Terry, I'm investing in your firm and into this corporation. I want some of that stock. I did the IPO. I'm one of the first firms. I get rights. I'm preempted. Okay. So again, it's mine. I got first right. I get first dibs, right? Okay. That's essentially what we're talking about here. All right. So when that registration of stock, it can also be lengthy, where there is what we call red herring prospectus, which is the preliminary version of the prospectus and that describes a new security. Essentially, this is just the amount of time that it takes before that's going to be released. Then we have what's called shelf registration, which allows firms that plan to offer multiple issues of stock over a 2-year period to submit one statement. So they're essentially saying, hey, here's a statement of registration for this particular stock. Okay. All right. I apologize. That's one of my big puppies. I'm sure you guys can hear. He's not a small, they're not small weenie dogs. And this is just an example, if you look at some of the illustrations of getting the shares of the stocks to the public and basically the time that it takes. Okay. So you've got the preparation. Okay. So we've got the, you decide, I've decided to issue stock, my firm, my bank, whatever you want to call me. I'm the investor. And I said, okay, I gave the money to the corporation. They now are operating. I want to sell that for stock. So I have to prepare paperwork for the SEC, the Security and Exchange Commission. Okay. And now we have what's called, during this evaluation period, we have what is called the red herring prospectus, right? So this is basically us saying, I'm sending to you, Ahmed, I got that stock coming soon. Do you want to be the initial investor? Woohoo! You get in at a good low rate. I'm sending you basically a marketing ploy. This is the prospectus. This is what can be expected. This is what you're going to get. You're writing a paper. That can take anywhere from, when you're talking that 1 to 20 days between the time that you've registered with the SEC and then again, where the SEC has now changes or requests additional information. Because the first time you submit to the SEC, and I've run into this with my business, when I submitted my paperwork to the state the first time, they came back with questions and concerns. All right. So if I was saying to you, Ahmed, that, hey, while I'm submitting that paperwork to them, they're reviewing it, I can let you know that I'm going to have this up and coming, right? Boom, boom, boom. You're going to want to get into it when it's live. All right. Then you have what happens. It can take anywhere from several days to several months. For me, with the state, I got them the changes. They took a day or two to issue me my approval information. We're talking about the same thing here. Okay. So it could take a few days to several months, depending on what you need to do for the SEC. After that is done, they issue you that official prospectus, that official proposal. Okay. Done. Your paperwork's been approved. And now, one day after, you can start offering your stocks to the public. Okay. That's essentially what we're doing here. But the public doesn't know about that prospectus. That was only issued to maybe certain persons. Okay. Certain companies. I'll say persons, excuse me. All right. And this is just the this is the illustration of shelf registrations. Okay. So again, just two different types of process. Now we have the secondary stock market. The secondary stock market is the market where the stocks, once they are issued, are traded by the investors. This is the New York Stock Exchange. This is NASDAQ, right? That's essentially what we're talking about. So in the market, we've got the money the funds are exchanged, usually with the help of a broker or a firm who acts on our behalf between the bank, the firm, that issued the stock, okay, and me. That's essentially all the broker is. They're the middleman, okay? But they got an important job because they're essentially they're keeping an eye on what's going on, and they're going to be providing guidance on what we should do with those funds. Okay. I think it's very important to real quickly mention too that the original issuer of the stock, they're not involved in this transfer of the stock or funds. Ultimately, that still goes back to the corporation. Again, they were just the front for the money. Okay. So they really still, remember when we were talking about mortgages, you had that investor, right? That said, I don't want the asset. I just want my money, right? So the bank still keeps that asset. That's essentially what we're doing here, but we're talking about the bank that said, hey, yeah, I'm going to give you that money as a company. So they gave my company the money. You are the one that the buyer of the stock is dealing with. We're just kind of that middleman. We issued the money and we're going to make money from issuing the money, right? I'm sure you've heard the term before. I got a good friend that works in accounting. You know, they always say, I want my money to work for me, essentially. Okay. So I'll give some money. That money needs to work for me and get me that interest. Now, we've got the New York Stock Exchange. Worldwide, the New York Stock Exchange, Euronext, is the most well-known of all the organized exchanges. Okay. Now, the exchange was created by the merger of the New York Stock Exchange and Euronext back in 2007. Okay, so now in conjunction, we had a merger that happens. So world leaders were for listings, trading in cash equities, equity, and interest rate derivatives, bonds, and the distribution of the market. So really what happened here is we've created our global stock market from that. And that's just where, again, the listings and things can occur. That's essentially what that was saying. Okay, so we've got a global stock market because of this. All right. What's the trading process? So all of our trading processes, all the transactions occur on the stock exchange, excuse me, at a specific place on the floor of the exchange, i.e. the trading post, and each stock is assigned a special market maker, a specialist. Okay, so there's a specialist looking over that trading that's going on. All right, now specialists are often the organize themselves as firms because of the amount of capital that's needed to serve that market. There are 3 types of transactions, okay, that can occur. We've got the brokers who trade on behalf of the customers at the market price, okay. Again, you're trading, if I was the broker, I'm trading on your behalf. Limit orders are left with a specialist to be executed. So there could be a specialist working on these limited orders, not directly between you and me working on our behalf. And there could be specialists transacting for their own account. Again, I would see this as a day trader, right? If I'm somebody that's working and looking at my own, I don't have somebody as a broker acting on my behalf. I'm acting for myself. That's a special transaction. Okay. Okay. A majority of the owners that are sent to brokers are of 2 types. There's, again, the market order, okay, where the order to transact is at the best price available when the order reaches the post. Okay. So the goal is to get that transaction at the best price available. And then a limited order is an order to transact at a specific price. So they're trying to get that stock to a specific price. That's it. Okay. A market order, again, they want to get the best price possible. Now, Ahmed, as an investor, you have shares of stock. Which would you want the person acting on your behalf to work on, as far as the orders go? What are you
Well,
trying?
a market order, it depends, of course, on the market.
Right.
A limit order is more secured, but maybe less price.
Exactly. Right. So remember, I mentioned the company I work with that put money in for my retirement. Okay. That firm, in many cases, may be working on the types of stocks that are going to get a limit order because, again, it's safe. My money can almost be a little bit more guaranteed. It's not as risky. But they also, to differentiate, they may be invested in 7 different companies. And so with each company, they're doing a different type of investment because they're acting on my behalf. And they want to get me money that's going to be there for retirement, but they want to do some of it at a risky chance, but they want it to be safe for me so I can guarantee that I'm getting money. Okay. So that's essentially one of the things we're looking at here. Okay. Program trading. This is simultaneously buying and selling of portfolios. Again, I just kind of mentioned this, of at least 15 different stocks valued at more than $1 million using computer programs to initiate the trade. Okay. Now these have been criticized for the impact that they have on the stock market prices and increased volatility. So essentially, because a company, again, we'll say that retirement company I'm working with has 15 different stocks they're working on that are all valued more than this, they're essentially trying to set the market, and that could have a negative impact on the up and down of the market. Okay. Now, the stock market actually, or New York Stock Exchange, introduced circuit breakers. So these are really trading curves to account for increased volatility. Okay. They're imposed to halt in trading that gives buyers and sellers time to assimilate incoming information. Basically, what they're trying to do is to say, "Ooh, I hate to say it, it's almost like Las Vegas, right? They want to keep a flow going there, but they don't want you to be able to kind of see where those trends are. So that's what they're doing. They're trying to put we got to put an even keel here, okay? And then we have what's called the limit up and limit down rules that basically halts trading on individual stocks if the stock price moves outside of a certain price band. And so what is the price band? That's the reference price, okay, the price that's referenced here. Plus or minus, though, the reference price times the percentage parameter. Essentially, what we're doing there is we're saying, okay, here's the percentage, here was the reference price, and we need to look at, this is the price band. So there cannot be a difference outside of that. Okay. And these are what we call about circuit breakers here. So this is an illustration. So in the event of a 7% decline in the S&P, so again, we've been seeing this in our stock market recently. Okay. If there's been a 7% decline, there is going to be a 15-minute halt before 325, but none after 325. So they could do it anytime before, but after there's no halts. So in the event of a 13% decline in the S&P, they could do this, right? So in the event of a 20% decline in the S&P, regardless of the time, the market closes for the remainder of the trading day. Okay. That's pretty significant. So again, if the stock market was to lose 20%, they're saying, we're done for the day. No more trading for the day. No, we've had too much decline. Too many people losing money. Well, again, why are they doing that? They're trying to protect the corporation, but they're also trying to protect you, because ultimately, what's going to happen? Ahmed, what do you think would happen if they kept that going after that 20%? What could potentially happen?
You lost me, Professor.
Okay. No, I'm glad. I want to make sure. Thank you for saying that. And I didn't mean that negatively when I say that. But what we're saying here is, on the stock market, they put that circuit breaker, right? So in a house, we have, if a surge in power occurs, right? We have a breaker that will shut off, because we don't want a fire or something to occur, right? We don't want the spark to occur that could cause a fire, something like that. We're putting the same type of circuit breaker in place on the stock exchange to say that if at 20, we see the market change by 20% in any given day that the stock market operates, we're shutting it down. We're flipping that circuit. Why do you think they would want to shut it down if it reached 20%?
To limit the losses.
Exactly, to limit the losses, because again, one of the things we don't want would be a crash, right? Well, that's the same thing when we're talking about that 7%. So what they're saying is that if before 325, anytime before that day, okay, during the times of operation of the stock exchange, if there's a 7% decline, they're going to take a 15-minute break. They're going to halt trading for 15 minutes. Why? They want to try to right the ship. They want to try and let it not dip any further. So they may say, hold on, we're not going to trade anymore for 15 minutes. Now, if that 7% happens after 325, because remember, the stock exchange only operates, I think it is, what I say, 4 p.m. Okay. If it's 325 and they've reached that 7%, they're not going to stop. They're not going to do a halt on the day. So they're not going to put that circuit breaker in play. Okay. But they may do it if it's before that 325, because there's a lot more trading to do. That's essentially what that means. Okay. Now, what are some of the controversial trading practices? This is something they want to stop and not allow to happen. We have flash trading. So in flash trading is a practice in which, for a fee, traders are allowed to see incoming buy or sell orders milliseconds earlier than general market traders. Okay. All right. What's happening here is Ahmed, I'm a broker. Ahmed says to me, hey, Terry, I'm going to give you $50 just so I can get a glimpse of what's about to happen. That's what we're talking about here. It's flash trading, right? That's illegal. All right. We have what's called naked access. It's not what you guys think. Naked access allows some traders to rapidly buy and sell stocks directly on the exchange using a broker's computer code without exchanges or regulators always knowing who is making the trades. That would be me giving to Chan, that would be me giving you my code and you being able to do the trading. So essentially, I've broken a contract with the SEC because I've given you the permission to use me as a broker, my code. Okay. That's essentially what we're talking about here. But the funny part is it was allowed up until late 2010. Okay. Dark pools of liquidity. This is where trading networks that provide liquidity but do not display trades on order books. All right. So let's look at that one a little bit before I go into clarify. So in 2013, the SEC approved a plan for new rules that requiring dark pools to disclose and detail their trading activities on their platforms. Okay. Trading networks that provide liquidity, but that do not display trades on order books. So in that sense, I'm thinking of the platforms, E-Trade, etc. Okay, and so they're required to disclose their detailed trading activity because you're not physically there, okay, during the day. Then we have what's called NASDAQ and the OTC. These securities are not sold on one of the organized exchanges, and they are traded over the counter. That's what we mean. So over the counter markets do not have a physical trading floor. The transactions are completed via electronic market. Again, E-Trade and some of the others, right? And NASDAQ was the world's first electronic stock market. Okay. It was primarily a dealer market where the dealers are the market makers who stand ready to buy or sell the particular securities. Okay. Kind of getting the middleman out of there, right? In contrast to the New York Stock Exchange, the NASDAQ is a negotiated market. Okay. And there are usually quotes from several dealers that are obtained before the transaction is made. We have what's called the small order execution system, which provides automatic order execution for individual traders with orders of less than or equal to 1,000 shares. So again, minimal numbers. Okay. All right. Now, choice of market listing. And I know we're running out of time. We're not going to get to 9 and 10. So here's actually what I'm going to do, guys. This that I was supposed to cover next week. Okay, 7, 8. I'll make all those assignments due on next Sunday. Okay, to help out since I just covered this today. And then what I'm going to do is next week we'll cover 3 chapters, and the following week we'll cover 3 chapters, and we'll make those assignments due at a normal date. Okay, because it's not fair for me to make 9 and 10 due next week because I didn't get to go over those. Okay, so just a FYI. Okay, choice of market listing. Firms listed with the New York Stock Exchange and Euronext must meet the listing requirements of the exchange. The requirements are extensive. The reasons a New York Stock Exchange listed is attractive to a firm is because it's improved marketability, right? Everybody knows it. It's publicity for the firm. Again, I'm the big boy. I'm New York Stock Exchange. That's where I want my stocks covered. Improved access to the financial markets. Again, there's more people there, right? Firms that do not meet the requirements of the New York Stock Exchange, they can exchange listings, trade on NASDAQ, okay? So they may not, my company may not qualify for the stock exchange, but it could qualify for NASDAQ, okay? Now, most of the NASDAQ firms, they're smaller, they're regional, or again, they can't meet the requirements of the organized exchanges. Over time, many of the NASDAQ firms will apply for New York Stock Exchange. Again, it's like me playing college basketball and then going to the pro, or I'm playing semi-pro basketball, I'm going to pro, right? That's essentially what we're talking about here. Okay. Then we have electronic communication networks and online trading. Now, major stock markets currently open at 9:30 and close at 4 p.m. on Eastern time, so my time zone, right? There are extended hour trading that involves any security transactions that occur outside these trading hours. So there are extensions. Most extended hour trading is processed through computerized, i.e., if I was working E-Trade right now from my computer, also known as ECN networks, such as ARCA or Instinet. Okay. Now, ECNs are computerized and they automatically match orders between buyers and sellers and serve as an alternative to the traditional market. So essentially, it's recommending to me what I should be investing in. Okay. That's essentially what we're talking about there. Then we have our indexes. Okay, the stock market index is the composite value of a group of the stocks. The Dow Jones, which is price weighted. The composite index, okay, which lists all the common stocks. You got the S&P 500, okay, which is the index that consists of the stocks of the top 500 of the largest corporations listed. You have the NASDAQ Composite Index, and you have NASDAQs, which are industrial banks and insurance companies as well. Okay. There's the Wilshire 500 Index. All right. Now, I'm not going to get into these last ones. Take a chance to read through these last ones. This was a pretty big section about it, but we're getting into, again, issues that might occur, some economic indicators, etc. Okay, does anybody have any questions today? Ahmed, any questions before we end? I know I have to respond to you, to your email, so I will get to that.
I will communicate directly with you, Professor. Right now, that's all too much.
It's a lot of information, isn't it? Okay. No worries. No worries. I appreciate that. Same thing goes for everybody else. If you guys, if this was too much information, you have questions, please reach out to me. Okay. I appreciate anybody that reaches out. If you don't understand, I'm happy to help in any way I can. So what we'll get ready and do, we'll go ahead and end class today. I'll make those adjustments for everybody in the Moodle platform. Again, you have until next Sunday if you haven't done anything on chapters 7 and 8, which we just covered today. And also, if you have work that's still outstanding, or if you don't see it graded, please reach out to me and I'll make sure it didn't get lost in my emails, okay? I'll do whatever I can. But I want to wish everybody a great morning, afternoon, evening, depending on where you're located. You know where to reach me. I'm here to help you guys, okay? All right, everybody.
Thank you, Professor.
All right, take care. I'll talk to you guys later.
Thank you.
So have a nice day, sir.
Bye, guys. Take care.